Nobody warned him, not his financial advisor. Nobody sat down with Richard and explained that the decision he made in 2023, a completely legal, completely reasonable financial decision, would show up 2 years later as a higher Medicare bill. And by the time he found out, the damage was already done. The money was already gone. If you are on Medicare right now, any investments, any property, this video could save you thousands of dollars. Because what I am about to share is something most financial advisors forget to mention. And the cost of not knowing it shows up quietly, every single month, for as long as you are on Medicare. Stay with me. His name was Richard, 68 years old, retired engineer from outside of Charlotte, North Carolina. Careful man. The kind of person who had a spreadsheet for everything. When he retired at 65, he had done all the right things. Solid retirement account. House paid off. Medicare enrolled. He felt prepared. Then in the spring of 2023, Richard and his wife sold their home. They had lived there for 27 years. The kids were gone. The house was more than they needed. They found a smaller place, put the difference in savings, and felt good about it. Smart move. New chapter. And this is where it gets expensive. 18 months later, Richard opened his Medicare premium notice. He expected the standard amount, the same number he had been paying since he enrolled. What he saw instead was a monthly charge almost $300 higher than expected. Not a billing error. Not a temporary adjustment. A permanent surcharge based on his income from 2 years earlier, the year he sold the house. He spent 4 days on the phone trying to understand what happened. And what he learned changed the way he thought about retirement planning completely. What Richard ran into is called IRMAA, the Income-Related Monthly Adjustment Amount. And this is what most people do not realize until they are holding a bill they never expected. IRMAA is a surcharge that Medicare adds to your Part B and Part D premiums if your income from 2 years ago was above a certain threshold. Not your current income. Not what you are earning today in retirement. What you earned 2 years ago. When Richard sold his house in 2023, the capital gain counted as income on his tax return. Enough to push him into a higher IRMAA bracket. Enough to trigger a monthly surcharge he had no idea was coming. And this is not even the worst part. The surcharge is not small. In 2026, IRMAA can add anywhere from $70 to nearly $350 per month to your Part B premium alone. A senior who expected to pay around $185 a month for Part B can end up paying over $500 a month. Because of income reported 2 years ago, Richard's total IRMAA surcharge was $264 a month for the full year. That is $3,168 from one transaction he made before he even knew IRMAA existed. He sat at his kitchen table and did the math. $3,000 gone because nobody connected the dots between a real estate transaction in 2023 and a Medicare bill in 2025. And this is exactly where people lose money. Now let me explain how IRMAA works, because the mechanics of it are what make it so dangerous. Not last year, not this year, 2 years ago. That number determines your premium today. So if something happened 2 years ago that pushed your income up, selling a house, taking a large IRA distribution, converting a traditional IRA to a Roth, selling investments, you may be paying a higher Medicare premium right now because of it. And you may not even connect that past event to your current bill. This is the invisible trap. By the time the surcharge shows up on your Medicare notice, the transaction that triggered it is already in the past, already filed on your taxes, already finished. There is nothing you can do to undo it. The 2026 IRMAA brackets are based on your 2024 income. If you filed individually and earned below approximately $106,000, you pay the standard premium, no surcharge. Between $106,000 and $133,000, you pay an additional $70 per month. Higher brackets carry surcharges up to $350 per month above the standard premium, and Part D carries its own separate surcharge on top of that, $264 extra every month. The following year, his income returned to normal. But IRMAA resets every year based on 2 years' prior income. The surcharge for 2025 reflected 2023 income. He had to wait it out. But this is not even the worst part, because Richard's story is actually one of the cleaner versions. Let me tell you about Margaret, 73 years old, retired schoolteacher from outside of Phoenix, Arizona. Margaret did not sell a house. What she did was follow advice from her financial advisor. Advice that is genuinely good financial planning, but advice that nobody had connected to her Medicare situation. Her advisor recommended converting her traditional IRA to a Roth IRA, pay taxes now at a relatively low rate, and all future growth would be tax-free. Sound strategy. Common recommendation. What her advisor did not calculate was that the conversion amount would count as taxable income in the year it happened, large enough to push her into a high IRMAA, a bracket. Margaret's combined Part B and Part D surcharge came to nearly $400 per month. For a retired schoolteacher on a fixed income, that is a car payment every month. Real money leaving her account because of a planning decision her advisor recommended without ever mentioning Medicare. What happened next surprised her. When Margaret finally found someone who understood both retirement planning and Medicare at the same time, she learned that IRMAA can be challenged. It is called a life-changing event review, using a more recent year's income instead of the 2 years prior figure. Qualifying life events include retirement from employment, a significant reduction in income, the death of a spouse, and divorce. What does not qualify is a one-time income spike from selling an asset. That was Richard's situation. His appeal was denied. Margaret's situation was different. Her Roth conversion happened around the same time as her actual retirement. The retirement qualified as a life-changing event. She did not eliminate the surcharge entirely, but she got it reduced. And that reduction saved her hundreds of dollars over the following months. The lesson from both stories is the same. You need to know IRMAA exists before you make the financial decisions that trigger it, not after. Before. This is exactly where people lose money. They make a perfectly reasonable decision, selling a house, doing a Roth conversion, taking a large distribution, without realizing that Medicare will be looking at that income 2 years from now. The financial decision and the Medicare consequence are completely disconnected in time. Nobody connects them unless they know to look. And the people who get hurt are not irresponsible people. Richard was methodical and careful his entire life. Margaret followed a licensed professional's advice. They did everything right. They just did not know about this one rule. There is also something worth understanding about couples. If you and your spouse are both on Medicare and file taxes jointly, a large transaction can trigger an IRMAA surcharge on both of your premiums simultaneously. Double the monthly impact from the same single transaction. A home sale that seemed like straightforward financial planning can quietly cost a retired couple $6,000 or more in a single year. Money they had no idea was at risk when they signed the closing documents. Now I want to address something that surprises people when they first hear about IRMAA. They assume it only affects wealthy seniors. But that is not how it works in practice. The income thresholds are not as high as most people expect. A home sale in a market that has appreciated over 20 or 30 years can generate a capital gain that looks enormous on a tax return, even for someone who never considered themselves high income. A Roth conversion that makes complete financial sense can push a modest retirement income over the bracket line. Required minimum distributions from a 401k, the mandatory withdrawals that kick in at age 73, grow every year as your account grows, and can gradually push you closer to an IRMAA, a threshold without you ever making a single unexpected financial decision. This is not a problem for the wealthy. It is a problem for people who saved well, lived carefully, and made sound financial decisions throughout their lives. And those are exactly the people who feel most blindsided when the bill arrives. So here is what you need to know to protect yourself. First, understand what triggers IRMAA. Capital gains from selling property or investments, IRA and 401k distributions, Roth conversions, rental income, business income. Any income that appears on your tax return as adjusted gross income can push you into a higher bracket if it crosses the threshold. A one-time event creates a 2-year consequence. Second, understand the timing. Today's financial decisions show up in your Medicare premium 2 years from now. By the time the bill arrives, most people have forgotten the event that caused it. The bill shows up in a quiet year. But something happened 2 years ago. Third, IRMAA applies to both Part B and Part D. Most people only think about Part B, but the drug plan surcharge adds to the total. Combined, the monthly impact on a fixed retirement income can be very significant. Fourth, if you are planning any major financial transaction, include IRMAA in the conversation before it is complete. A financial advisor who understands Medicare can help you look at projected income against the brackets. Sometimes timing can be adjusted. Sometimes an amount can be split across 2 tax years. But those options only exist before the income happens, not after. Fifth, if you are already paying a surcharge and you have had a significant life change that reduced your income, the SSA 44 form allows you to request that Medicare use a more recent year's income. It requires documentation, but if you qualify, it can reduce or eliminate your current surcharge. This form is available through Social Security and worth pursuing if your situation has genuinely changed. Sixth, and this is for people who have not yet enrolled in Medicare, start thinking about IRMAA before your enrollment date. Know what your income has looked like for the past 2 years. If something large happened in either of those years, understand that it may affect your Medicare premium from day 1 of enrollment. The planning window does not start when you receive your Medicare card. It starts years before. Richard cannot go back and change his house sale, but he will never make another major financial decision without running the IRMAI numbers first. He knows where the brackets are. He looks at his projected income every year. That awareness costs nothing. The absence of it cost him over $3,000 in 1 year. He told me the thing that bothered him most was not the money. It was knowing this was completely avoidable, that the information was right there in the Medicare rulebook, and nobody whose job it was to help him plan his retirement had ever brought it up. Margaret said something similar. Her financial advisor was a good person, knowledgeable, experienced in retirement accounts, but he did not know Medicare, and nobody told her she needed someone who understood both. She walked into a $400 per month surcharge. Because 2 separate systems, retirement planning and Medicare, were never connected in a single conversation before she made her decision. That gap between financial planning and Medicare planning is where thousands of dollars disappear every year for seniors across this country. And it is one of the main reasons this channel exists. That feeling of being blindsided by a system you thought you understood is exactly what this channel is here to prevent. If you have had any large income event in the past 2 years, and you have not looked at how it maps against the IRMAA brackets, do that now. Pull up your most recent tax return and look at your adjusted gross income. Compare it to the thresholds I described. If you are close to a bracket line or already past one, You need to understand how your current Medicare premium was calculated and whether anything you are planning in the next year or two could push you into the same situation. If you are planning a significant financial move, make IRMAA part of the conversation before the transaction is done, not after, before. And if you want free guidance, your State Health Insurance Assistance Program, SHIP, has counselors who understand Medicare premiums and can help you review your situation at no cost. Find your state's program at Medicare.gov. Share this video with someone who is thinking about selling a home, doing a Roth conversion, or making any significant financial move in retirement. Because the cost of not knowing this rule shows up quietly, 2 years later, on a bill nobody expected. One conversation at the right time could save them thousands. Richard knows now. Margaret knows now. And now you do too. The next video covers Medicare scams targeting seniors right now in 2026. People actively trying to steal from you using Medicare as the door. If you or someone you love has ever answered a phone call about Medicare, that video is essential. It is coming up next.